Markets are often driven by perception. The Fed, the economy, and inflation. These are narratives that shape investment decisions. But in reality, interest rates don't move in a vacuum. What really matters right now isn't the Fed's short-term rate. It's the 10-year Treasury yield. And Scott Bessent and the Trump administration know that better than anyone. For years, monetary policy has focused on short-term interest rates. But the administration's strategy is different. Focus on 10-year yields instead of the Fed's overnight rate. Why? Because 10-year treasuries dictate mortgage rates, corporate borrowing, and long-term economic growth. After the Fed's 50 basis point cut last September, we saw something unexpected. 10-year yields climbed. The Fed lost control of the long end of the curve. What Bessent and Trump are signaling is clear. Instead of waiting for Powell to act, they're focusing on real economic levers: supply-side growth, deregulation, and energy expansion. Inflation isn't just about rates. It's about supply constraints. The biggest inflation driver for working-class Americans? Energy costs. If gasoline and heating oil drop, discretionary income rises, optimism returns, and economic confidence strengthens. The administration's plan: expand U.S. energy production by 3 million barrels per day. That's not just about lowering costs at the pump. It's about stabilizing inflation expectations long-term. And when expectations shift, markets follow. This ties directly into the 3-3-3 framework Bessent is pushing. Reduce the deficit to 3% of GDP. Increase oil production by 3 million barrels and sustain 3% GDP growth. It's an ambitious but coherent strategy. Reducing the deficit while boosting energy production? That's the supply-side bet. Because if growth is fueled by private investment rather than government stimulus, inflation stabilizes and rates take care of themselves. That brings us to the next move: extending the 2017 tax cuts permanently. Lower corporate taxes mean higher retained earnings, more capital investment, and ultimately, a more competitive U.S. economy. The message from the administration is clear. They're betting on private sector-led growth, not government spending. If energy costs fall, tax incentives stay, and regulatory burdens decrease, capital flows back into the U.S. economy instead of overseas. So, what does this mean for markets? Investors should pay close attention to 10-year yields, not just Fed moves. Energy prices will be a leading indicator of inflation expectations. And tax policy could be the deciding factor for long-term U.S. growth. If the administration succeeds, we'll see a more sustainable, investment-driven expansion. If not, the Fed will remain the central player, and we could be back in a cycle of reactive rate moves. Either way, this is the narrative to watch. I'm Bill Ackman, and this is how I see it.